Hey guys, it's Aman
and Christina
from Our Rich Journey. Today we are going to show you the easiest way to start building wealth with the most simplest portfolios. In fact, we are going to talk about two types of portfolios that you can build, and they are so straightforward. Because this is a question we get all the time. How should I go about developing my investment portfolio? What should my asset allocation be? And so we're going to share with you guys some portfolios that have been tested over time. And we're going to run some scenarios to show you how you can build millions of dollars in these types of portfolios. And so we are really excited about this video.
Yes, so this video is really for those beginning investors that don't really know what to invest in, or maybe you're already investing, but you don't really have a plan, or your plan is way too complicated. We are gonna give you specific investments to look into. We are gonna analyze the investments, we're gonna talk about the performance, and we're gonna walk you through these specific investments. So when you are picking investments, you have so many different options. You can do individual stocks, index funds, ETFs, REITs. But in this video, we're going to focus specifically on ETFs. And we're doing that because ETFs allow anyone based off of any platform or brokerage firm that they're investing in, they can invest in ETFs. So for those of you that don't know, an ETF is an exchange traded fund, and it's like a basket that holds many different investments like stocks or bonds. And an ETF is traded on stock exchanges similar to how stocks are traded. So typically an ETF aims to track an index, a commodity, or a basket of assets. So here's an example. If you invest in an S&P 500 ETF, just by investing in that single ETF, you are investing in all of the 500 largest companies in the US stock market.
So now that you know what an ETF is, let's talk about a portfolio that is built off of 3 different ETFs that you can use to begin your investment journey. And this type of easy portfolio is called the 3-fund portfolio because it is made up of 3 ETFs. Now, we are going to talk about which ETFs that typically go into a 3-fund portfolio, but we want you guys to stick around to the end because we're going to throw a curveball at you that could simplify your portfolio even more and give you greater returns.
So let's get started with the 3-fund portfolio. We'll start with the first ETF in that portfolio, and it is VTI. So VTI is a total stock market ETF, and by investing in this ETF, you would be investing in more than 3,800 companies in the US stock market, with more than 30% of this ETF being weighted in the technology sector. Its top 5 holdings include Apple, Microsoft, Amazon, Nvidia, and Google. It has an expense ratio of 0.03%. Year to date, it has returned 12.18%. Since its inception in 2001, VTI has had an average annual return of 7.82%, and over the past 10 years, it has had an average annual return of 11.23%. So the second exchange traded fund in your 3-fund portfolio is an international stock market fund, VEU. So VEU is an all-world ex-US ETF. It invests in developed and emerging non-US equity markets around the world. So by investing in this ETF, you would be investing in more than 3,700 different companies outside of the US, with about 41% of those companies being within Europe and 25% in emerging markets. VEU has an expense ratio of 0.08%. Year to date, it has returned 5.17%. Since its inception in 2007, VEU has had an average annual return of 3.03%, and over the past 10 years, it has had an average annual return of 3.66%. So the third and final exchange traded fund in your 3-fund portfolio is a domestic bond fund, BND. So BND is a total bond market ETF. It invests in the taxable investment grade US dollar denominated bond market, excluding inflation protected and tax exempt bonds. So by investing in this ETF, you would be investing in more than 10,000 bonds, with roughly 65% of those being US government bonds. So BND has an expense ratio of 0.03%, and year to date, it has returned negative 1.55%. Since its inception in 2007, BND has had an average annual return of 2.64%, and over the past 10 years, it has had an average annual return of 1.11%.
So with those 3 exchange traded funds in your 3-fund portfolio, you have a portfolio. But the big question that everyone should be asking is how much or what percentage in my portfolio should I own of each one of these ETFs? That is a great question, and that is the most important question you should ask yourself when you are developing a portfolio. What should be your asset allocation plan? Or in other words, what percent of each investment should make up your portfolio? Well, we have a great answer to that. We are going to refer to a group of investors that are well respected, the Bogleheads. You see, the Bogleheads have actually made the 3-fund portfolio famous. So their recommendation is that you invest 50% of your money in VTI, you invest 30% of your money in VEU, and you invest the remaining 20% in BND. This portfolio has been touted by many investors, including the Bogleheads. But Christine and I, we are very critical type of people. We always like to do our own research. Now, if you just blindly put your money into this asset allocation, your money would do okay. But how does this investment portfolio compare to just putting all of your money into one ETF, VTI, the total stock market? We've talked about this before in the past when we've talked about what is the most efficient way to build wealth in the stock market. We have talked about VTI and VTSAX. So we were curious and we ran the numbers and compared how the 3-fund portfolio would compare to just investing all of your money in the total stock market.
So we really wanted to do this comparison because our personal preference is we do not invest in any bonds. And we noticed that the 3-fund portfolio has a 20% allocation to bonds. Right now, if you were paying attention to the numbers, year-to-date bonds have produced a negative return. And historically, bonds have underperformed compared to the total stock market.
So because of this, one can't beg to ask the question, why invest in bonds if they are underperforming and being a drag on your portfolio?
So let's look at the numbers because we analyzed the 3-fund portfolio of doing 50% in VTI, 30% in VEU, and 20% in BND. And we looked at the past 10-year performance of these specific ETFs and found that over the 10 years with that type of allocation, you would have a 7.06% average annual return. Now remember, VTI alone, which is the total stock market index fund, has produced an average annual return over the past 10 years of 11.23%.
11.23%. That is a big difference as far as performance when you are looking at the 3-fund portfolio versus just investing in VTI. But to really drive this point home, we put in some real numbers to see how your dollars would perform over that same period.
So let's say you invested $1,000 a month over the past 10 years in the 3-fund portfolio. That would give you $166,267. But if you invested solely in VTI, which is the total stock market ETF, over that same 10-year period with that 11.23% return, you would have $202,900. So that is a difference of almost $40,000 by taking the approach where you're just investing in the total stock market. But that again is just over a 10-year period. So let's say it continued at that same rate of return and you invested $1,000 a month in the 3 ETFs over a period of 30 years. You would have $1,145,839. But if you invested in just the total stock market ETF, VTI, over that same 30-year period, you would have $2,496,000. So that is more than double the amount of money that you would get if you invested in just the total stock market versus this 3-fund approach. But there really is a catch to this because the 3-fund approach was developed for a couple of reasons. One is to diversify your portfolio even more, and the second is to adjust for different risk tolerances. When you invest in something like bonds, for example, the returns are going to be lower, but you typically have less volatility in your portfolio over the long run. And people that that have a low risk tolerance tend to like less volatility in their portfolio.
And the international ETF in the 3-fund portfolio also gives you this global diversification. A lot of people like this because they like to spread their risk across the entire globe. And so these are things that you have to take into consideration whenever you are building your portfolio. Your risk tolerance, diversification, how you want to grow your wealth. At the end of the day, it's up to you how you build your portfolio. And so we created this video to give you guys some food for thought. We have a very unique portfolio. In fact, we have more than 8 investment accounts with multiple portfolios in those investment accounts, but they are all focused on one ultimate goal of growing our wealth for financial independence. Now, if you guys are interested in seeing how we have grown our wealth for financial independence, we will leave a link in the description below to our Fire Masterclass. It is a class that is more than 4 hours long that goes into ways to make, save, and invest money for financial independence and retiring early. In that course, we show you our specific stock investments and our stock investment plan for FIRE. Check out the course in the link in the description below. And as usual, if you like this video, please give it a thumbs up, subscribe to our channel, and join the journey.